Hi there, I'm Champion Trader Kevin Davey, and today we're going to build a simple trading algo for crude oil. So let's get started. Okay, so we're going to build a simple algo, but first I want to show you what most people do when they build algos so you can avoid it. So most people build a backtest that kind of looks like the picture that's shown on the right here. It's a nice kind of upward sloping equity curve, and then they finish around the area in the red. So focus on that because then they go live right at that point, and you can see there's where the red period is, and once they start going live they just lose money and it just dives, and the equity curve is terrible. And what that leads to is a lot of frustration, pulling out your hair. Like, why can't I make algos that make money in real time? I can make good looking back tests. We're going to hit on some of those things in this video. But that's what most people do, and that's why a lot of people lose money. Is they build good back tests, but then the back test is built on shaky ground, and when it goes live it falls apart. I'm going to build a strategy using some best practices. These are ones I teach in my Strategy Factory course. So there's a whole lot more info than just what I'm giving you here, but this gives you an idea of the right way to build algos. And in my course, what I do is I teach a step-by-step process to build a strategy. And you build it first on a small amount of data. You don't optimize a whole lot. You use walk forward testing, although in this case I didn't do it just in the interest of time. And then you watch the strategy in real time before committing capital to it. This particular strategy was developed in 2021. It's been live since May of 2022. And I think you'll like what it has done since that period of time. These are the steps I follow for every strategy I build. They're pretty straightforward, but the devil is in the details. It's meaning there's a lot of little nuances and a lot of little things I do during these steps to help make sure I don't curve fit, that I don't over optimize. Let's talk about performance goals. I've talked about this in other videos, and so you're probably like, oh my gosh, he's talking about goals again. But it's critical. If you don't have good goals, you're going to be in trouble. So my goal for this strategy was just develop a simple strategy, don't do any optimization, and do it on crude oil daily bars. So pretty straightforward. And it must pass my Strategy Factory criteria, some of which I'll show as we go on in this video. So that's my goal, just to build a simple strategy without optimization. The next step is you got to come up with a trading idea. So here, I'm going to rely on some of my experience. I know momentum is a good way to enter the market, and all that is a trend follower. If the close of today is greater than the close so many bars ago, well, that's a good indication you should go long. Okay? It's just a trend follower. I'm also going to add an ADX filter and a profit target. So if we take a look at this, here's the code. It just says if the ADX is above a certain number and the momentum is going up and it crosses above 0, then we buy. Opposite to sell short, we have a stop loss, we have a profit target. Pretty simple. Now, you might say, well, okay, why are you doing what you're doing? So let's dig into those kind of things a little bit. Just get a little more information. First thing is why momentum and why 65 bars, okay? Then we'll say, well, why the ADX and why the 10 threshold? Well, to back up, let's talk about that momentum. So the reason I use momentum is I have just found it to work really well in numerous different occasions. And 65 bars is about 3 months, roughly, of trading of daily bars. So that's why I use the 65. I'm getting a what I would call a medium term momentum length, and that's what I'm saying is going to be good for a trend. Then when you look at the ADX, you can see in this chart, it's a little hard to see, but you can see when it goes above and below 10, and that's what we're going to use as our threshold. Then we look at stop loss. $3,000 stop loss, $4,500 target. And you might say, where do those numbers come from? Well, the key is the stop and the target. That's your reward to risk relative to your winning percentage. So here's a chart that shows you how reward to risk and winning percentage tie in together. Now, a lot of people say, oh, you must have a 3 reward to risk, or you must have an 80% winning percentage. The fact is, those two numbers only are meaningful when they're together. And when they're together, you can create this curve, this red curve. Anything to the left of the curve is going to be unprofitable. So let's say you had a 20% winning percentage with a 2.0 reward to risk. That would put you right here. That is unprofitable. So if you're trying to trade that strategy, you're going to lose money. Whereas if you had a 2.0 reward to risk and you had a 60% winning percentage, you'd be over here. All those blue dots are just strategies I actually trade just for reference, but the good thing is they're all to the right of that curve. So you can use this curve to help you figure out what reward to risk should be and what your winning percentage, what kind of winning percentage you want to aim for. So in the example I just gave of this crude oil strategy, I had a $4,500 reward to reward, $3,000 stop loss. That would be 1.5. So I'd be somewhere along here. So I need at least a 40% winning percentage or higher to be profitable. The next step, I have my basic code and everything. I run what I call limited feasibility testing. I just run it on a couple of years just to see, could this make a profit? If it doesn't, maybe I'll tweak some things or maybe I'll just throw it away. But this is a great step to prevent you from testing too much. And in this case, it made some money, so I felt comfortable that, hey, maybe there's something to this strategy. Doesn't mean the strategy's good at this point. Let's be clear. It just says, hey, it passed a little hurdle. It might be worth testing further. The next step is walk forward testing. For this particular strategy, I didn't do that because I'm not optimizing. Then the next step is Monte Carlo simulation. You can go to my website and get a free Monte Carlo testing tool for Excel. But what I do is I take all the history and all the historical trades, I put them in this simulator, and I run some simulations of what kind of return and what kind of drawdown I can expect. This is the equity curve for that particular system, again with no optimization. Hey, it looks pretty good. The Monte Carlo, the results when you run it in my Monte Carlo spreadsheet, they look pretty good. I usually look at return to drawdown. I think that's the most important number. It includes return, obviously. It includes risk, which is your drawdown. That's why it's a good number to use. So it passed that step. The next step is incubation. Now, incubation is just watching a strategy in real time. You want to make sure it doesn't fall apart. And if it doesn't, then you can use real money. You might say, well, do I really have to do that? Well, I've surveyed my students a number of times, and somewhere between 85 and 90% of them say incubation has saved me money. So it's a great thing to do. Here's the incubation results. So up until the blue area, that was when I originally developed the system. And then the blue area is what its performance was in real time after I built it. And you can see it's still going upward and to the right. So that's pretty good. That would give a thumbs up there. Next, I do diversification and position sizing. Really won't talk about it too much here because that's more of a portfolio type thing. And then I go to real time. And you can see the area in green is how this strategy is performed after incubation in real time. So remember, I stopped development of this strategy at the end of that white area, and everything after that, I didn't touch that strategy. So it's continued to perform well. And that's what you're looking for in strategies you build. You're looking for them to perform well in real time and also incubation. But if they don't, then you know something's probably wrong with your process if you do that enough times and can't get winning trades. So here's what it is through the current date, or approximately the date of this video. It's still doing pretty good. That's nice to see. Not bad for a free strategy, right? Of course, I left out a lot of the details here. I didn't tell you what a good algo is. I didn't give you all the steps to develop it. And, we didn't optimize it all. But you've got to worry about over-optimizing. And then I mentioned I didn't do walk-forward testing. Well, what's that? How do I do it? And then what if that strategy had fallen off? When do you stop trading it? There's so many questions out there if you're kind of inexperienced, or even if you've been algo trading for a while. A lot of times you don't even know what you don't know. And that's where my course and my help can be a great service to you, because I've been through all this and I know how to do a lot of these things. Well, I hope you like this simple video. If you want the actual code, you can copy it from the video, or you can actually just go to my website, just sign up for my email list. You'll get the code, a lot of other freebies, and you can trade it yourself. Thanks for watching. I'm Champion Trader Kevin Davey. Have a great day.